Most people believe that saving money is simple. Spend less than you earn, keep a budget, and wait. That's what your parents told you. That's what every financial guru on YouTube claims. And yet, most of us still fail. Month after month, paycheck after paycheck, the numbers in our accounts barely move, despite discipline, despite effort. Why? Because what you've been taught is not just incomplete, it is actively misleading. Here's the hidden truth. Your financial reality is controlled by invisible systems, subtle architectures you can't see, but that govern exactly how money flows, multiplies, and evaporates. It's not about willpower. It's not about laziness. It's about patterns, hidden, structural, and often unconscious, that dictate outcomes before you even make a choice. Imagine your money as water in a network of pipes. On the surface, it seems straightforward. Pour it in one end. It fills the tank. But in reality, your pipes are leaky, corroded, and full of unseen twists. Each month, a tiny leak siphons off 5%, 10%, even 20% of your potential growth. And because you can't see it, you don't know it's happening. By the end of the year, your savings are less than half of what they could have been. And the worst part? The leaks aren't random. They are predictable, systematic, and nearly impossible to fix unless you understand the structure. Here's a second layer most people never see. Biology itself is against you. Your brain is wired to seek immediate reward, to respond emotionally to scarcity and status cues. Every sale, every flashy advertisement, every social comparison triggers neural circuits that pull you toward spending. You think you're in control? But in fact, the dopamine-driven system is quietly draining your bank account. Your habits are not accidents. They are evolutionary responses in conflict with your modern financial environment. And there's a third layer, the invisible social contract. Society programs you to measure success with consumption. You're surrounded by signals, friends upgrading phones, neighbors remodeling kitchens, co-workers posting vacations on social media. Each signal subtly reshapes your perception of adequacy. You begin to believe that to belong, you must spend. And the more you earn, the more the pressure compounds. It's a hidden gravitational force, pulling your financial potential downward, even when you're highly intelligent, highly disciplined, and highly motivated. Most financial advice stops here. They tell you to budget, to cut discretionary expenses, to just save more. But they ignore the underlying architecture. They ignore the hidden patterns that destroy savings, the subtle leaks in the system, the behavioral traps, the social and psychological programming. Without seeing these patterns, every effort is like bailing water out of a sinking ship. Heroic, exhausting, and ultimately futile. Here's what changes everything. The moment you start seeing these patterns, you stop blaming yourself. The shame, the guilt, the endless cycle of, "I should have saved more," it evaporates. You realize the problem is not your character, not your discipline, not your intelligence. It's the structure. And structures can be understood. They can be mapped. They can be redesigned. What if I told you that 80% of what makes or breaks your savings is invisible? That by understanding just 3 hidden patterns, you could protect, accelerate, and even multiply your capital in ways that feel almost effortless, but only if you see the architecture before you act. The first pattern is subtle. It's hiding in plain sight. It's one of the most overlooked mechanisms of financial erosion, and it has been quietly siphoning wealth from millions, maybe even from you, without a single conscious decision. By the end of this video, you won't just understand why most people fail at saving. You'll see the hidden system, piece by piece. You'll see how your biology, your psychology, and the invisible architecture of society converge to control your financial outcome. You'll see the traps, the leaks, and the pressure points. And most importantly, you'll see how to break free, strategically, scientifically, and systematically. This is the trap. This is the hidden design behind every missed saving goal. And yet, once exposed, it's also your greatest opportunity. Because patterns, once visible, can be changed. Leaks, once mapped, can be sealed. Behavioral tendencies, once understood, can be rewired. But first, you need to see them. You need to watch the invisible scaffolding behind every financial decision you make. Because until you do, no amount of budgeting, no amount of willpower, and no amount of discipline will ever create the security and freedom you crave. And the first pattern, the one silently devouring your savings, lies in the intersection of structure and behavior. It's the part no one talks about, yet it controls everything. It's invisible, insidious, and it will be revealed in the next section. The first hidden pattern is deceptively simple. It hides in plain sight, disguised as routine. Most people think of savings as a linear process. Income comes in, expenses go out, leftover money accumulates. But the invisible architecture controlling your financial reality is far more complex and far less forgiving. This system operates on rules you rarely see, yet it governs outcomes with mathematical precision. Understanding it is the first cognitive shift in reclaiming control. Imagine your personal finances as a layered ecosystem, not a ledger. At the base is your income, the energy input. Above it, the structural elements, recurring bills, discretionary spending, taxes, and invisible service fees. Then come the psychological layers, habits, impulses, and beliefs about what is enough. Each layer interacts, each often amplifying minor leaks into catastrophic erosion. A single overlooked pattern can eliminate months of savings before you even notice. This is why discipline alone fails. You're battling forces you cannot see. Let's dissect the mechanics. Take automatic fees, subscriptions, microtransactions, payment rounding. Each month, $5 here, $12 there, $1.99 recurring payments, individually negligible, collectively devastating. The system is designed to make these leaks invisible. You don't feel $20 slipping away each month, but in a year, that's $240. 5 years? $1,200. 10 years? Over $2,400. And this is just one structural component. Multiply it across multiple accounts, services, and small indulgences, and you have a systemic drain. Now, layer in behavioral invisibility. Humans underestimate frictionless loss. When money disappears passively, no conscious spending, no decision fatigue. the mind treats it as neutral. You feel no loss, yet your financial position weakens. This is not a moral failing. It is the natural outcome of interacting with a system designed for hidden efficiency. Understanding this is liberating. You're not careless. You're exposed to a structural environment engineered to siphon without detection. Recognizing this removes shame. It replaces it with clarity. Next is the cognitive trap of anchoring. Many people set savings goals as static numbers: $500 per month, $10,000 per year. But without accounting for structural drains, these goals are illusions. They assume that all incoming capital is available for accumulation. They ignore leakage, psychological spending triggers, and subtle lifestyle inflation. Most personal finance tools reinforce this illusion, presenting neat graphs that hide erosion beneath the surface. This is why budgets fail. This is why even disciplined savers rarely see exponential growth. The system's architecture doesn't care about good intentions. It responds only to measurable flows, inputs, and leaks. Here is the first cognitive shift. Money must be treated as a dynamic system, not a static account. Every dollar is not equal. Some dollars flow directly toward wealth creation. Others are lost in friction, behavioral impulse, or hidden costs. Mapping these flows is essential. It is a structural audit, but deeper. It is a behavioral audit of your financial ecosystem. Once you see the flows, patterns emerge. You begin to anticipate leakage, counteract psychological impulses, and reclaim energy that has been passively lost for years. Consider the effect of habit stacking, or the lack thereof. If you attempt to save only when motivated, you are vulnerable to structural drain. Motivation is ephemeral. Systems are persistent. Successful accumulation depends not on discipline in the moment, but on designing automated structures that redirect capital before behavioral leakage occurs. The invisible architecture here is the combination of timing, channeling, and automation. Small adjustments, like redirecting a fraction of income to a high-yield account before discretionary funds are accessible, transform passive erosion into passive accumulation. The system itself can become your ally. And yet, there is more. Human perception is a major blind spot. We tend to overestimate our control, believing that conscious choices dominate outcomes. But in a layered financial system, the unconscious dominates. Behavioral patterns, environmental nudges, and social comparison pressures operate below the surface, systematically reducing what you can save. Until you internalize this, you will continue to fight a battle with one hand tied behind your back. Recognition is the first step toward leverage. The invisible structure is not evil. It's simply neutral physics applied to human behavior. Money moves according to rules: time, friction, and systemic incentives. Once you comprehend these mechanics, the landscape changes. You begin to see that the first hidden pattern destroying your savings is the interaction between invisible structural drains and passive behavioral leakage. Alone, it seems small. Together, it is unstoppable. So the key is not more discipline. It is structural redesign. And here's the open loop to carry into the next section. Understanding the architecture is only half the battle. The moment you grasp how the system leaks, you will confront the second pattern. One that is psychological, not structural, and far more insidious. It is rooted in behavior, identity, and emotion, and it silently dictates how every dollar is spent. Until you see this second pattern, your savings are perpetually under siege. The second hidden pattern is far more insidious than structural leakage. It does not show itself as a missing dollar or a micro fee. It hides inside you, inside the very circuitry of your mind, the habits of your emotions, the illusions of identity. This is the pattern of behavioral sabotage, the unconscious forces that compel you to spend, you even when you know better. Understanding this is where the silent war for your savings truly begins. Humans are wired for instant reward. Every flash sale, every limited time offer, every social media highlight triggers the same neural pathways that ensured survival in a world of scarcity. Your brain treats symbolic losses and gains with the same urgency it once treated life or death decisions. That $300 sneaker purchase, that extra dinner out, that subscription to yet another convenience service, your neural architecture justifies them. You feel satisfaction in the moment, and the rational part of your brain defers responsibility. Months later, the cumulative impact is enormous, yet invisible. Then there is identity-based spending. Most people think they make financial choices logically, yet identity illusions dominate behavior. You buy what signals who you are, or who you want to be. A high-status phone, a luxury brand, a car that projects competence or freedom. These are not purchases. They are statements. The irony is brutal. You think you are investing in yourself, but often you're financing the illusion of yourself. Savings erode not because of necessity, but because of social signaling. Status inflation is relentless, compounding like interest, but in reverse. Every dollar spent to keep up is a dollar your future self never sees. Consider the social comparison trap. It's not just that humans compare, it's that we do so continuously, unconsciously, and in contexts that distort reality. Social feeds present curated snapshots of wealth, success, and consumption. Your unconscious mind interprets this as baseline reality. Suddenly, your modest apartment, your used car, your carefully budgeted lifestyle feel inadequate, not objectively, but psychologically. You adjust, not for need, but for perception. Your savings are siphoned to signal adequacy, and you rarely notice. This is why intelligence or income alone does not prevent financial erosion. Highly capable, highly rational individuals are some of the worst victims of behavioral drain because they overcompensate subconsciously. The emotional triggers extend further. Anxiety, fear, and scarcity distort judgment. Scarcity thinking makes you impulsive. Anxiety makes you reactive. The same stress that compels productivity can also compel spending, as reward-seeking temporarily alleviates tension. This is the emotional escape valve pattern. It feels harmless, a cup of coffee, a small gadget, but it accumulates exponentially. The architecture of behavior, amplified by emotion, silently devours savings over time. And yet, this pattern is invisible precisely because it masquerades as choice. You feel agency. You believe you are in control. But true control is not conscious intention. It is structural alignment of identity, environment, and behavior. Until you recognize these patterns, every financial plan, every budget, every spreadsheet is incomplete. Awareness is the key. You cannot fix what you cannot see. Behavioral finance research confirms this. People routinely underestimate future spending, overestimate self-control, and misattribute success to effort while misattributing failure to external factors. The system is against you, not maliciously, but mechanically. Every cognitive bias, from hyperbolic discounting to the endowment effect, unsubtly redirects capital toward immediate gratification. You may intellectually reject impulse purchases, yet the system exploits timing, attention, and emotion to override rationality. It's not failure, it's design. The cognitive shift here is profound. Your identity is both the problem and the solution. You cannot merely try harder. You must redesign the psychological scaffolding that drives behavior. You must recognize that every dollar spent has a narrative attached. Who you think you are, who others perceive you to be, and the fleeting emotional reward that momentarily satisfies your primitive circuits. Once this mapping is visible, you gain leverage. You can start redirecting flows, automating decisions, and insulating savings from your own unconscious sabotage. So here is the micro cliffhanger that leads into the next revelation. While behavioral sabotage explains why you spend, it does not yet quantify the damage. It does not show how tiny, repetitive choices compound into systemic collapse, or how thresholds of capital can either accelerate or decimate your ability to save. That is the domain of the third hidden pattern, the mathematical architecture of erosion and growth. It is precise, relentless, and unavoidable once the rules are exposed. Until you understand it, your savings remain hostage to both invisible structure and unconscious behavior. But the moment you map the third pattern, everything changes. The traps, the velocity, the thresholds become visible, and you start to see the path to true financial control. If the first pattern is structural leakage, and the second is behavioral sabotage, the third hidden pattern is the one most people fear but rarely see, the mathematical architecture of erosion and growth. This is where psychology meets physics, and the numbers reveal the truth no emotion or motivation can hide. Your savings are not just being stolen, they are being reshaped by invisible forces of compounding, thresholds, and velocity. And until you see it, all your efforts are only scratching the surface. Consider compounding, not the generic money grows over time cliché, but compounding erosion. Small losses multiply. Imagine a recurring $200 leakage each month from frictional spending, impulsive purchases, or hidden fees. Alone, $200 is trivial, but with compound interest against you, lost opportunity costs, foregone returns, I missed tax advantages, that $200 can cost you over $5,000 in lost growth over 10 years. This is the silent mathematics that destroys what most call savings discipline. You think you're saving, but you're falling behind. The system does not care about effort. It responds only to flows. Now, flip the lens. Growth compounds faster than most anticipate, but it requires hitting thresholds. Consider a simple model, starting with $5,000, investing with a modest 7% annual return, adding $200 per month. Your portfolio crosses $20,000 in roughly 6 years. Increase the starting capital to $10,000, and you reach $20,000 in under 4 years, doubling the initial buffer cuts time by a third. This illustrates the velocity principle. The earlier you recognize patterns and reclaim structural and behavioral leaks, the faster your capital moves. At every month you lose is a compounding penalty that cannot be recovered. Wealth velocity is the invisible engine few understand. It is not income alone, nor savings alone. It is the interaction of capital, compounding, and timing. Each dollar freed from behavioral sabotage and structural leakage moves exponentially toward growth. The same $200 that destroys $5,000 over 10 years when lost can, if redirected, generate $5,000 in gains over the same period. This is why the mathematical pattern is merciless. Time magnifies both mistakes and corrections. Small changes now create enormous downstream effects. Thresholds matter even more. Certain tipping points unlock asymmetrical growth. For example, in investment portfolios, crossing $25,000 or $50,000 often allows access to higher yield instruments or lower cost structures. But below these thresholds, growth is throttled by fees, taxes, and limited opportunities. The pattern is clear. Failing to capture early momentum or letting behavioral and structural leaks persist prevents you from reaching thresholds where real leverage begins. Many disciplined savers never breach these thresholds, trapped in a cycle of steady but slow accumulation. The architecture is mathematical, precise, and unforgiving. Escalation illustrates this further. Take two individuals. Alex saves $500 per month but allows $100 per month in leakage. Jordan saves $500 per month but eliminates the $100 loss. 10 years later, Alex has accumulated approximately $75,000. Jordan, by contrast, has over $95,000, $20,000 more for the same effort. The difference? Awareness of the patterns, recognition of where invisible erosion occurs. The compounding does not reward good intentions. It rewards structural mastery. Even more insidious is the interplay with income growth. Many assume that higher income solves the problem, but without correcting structural leaks and behavioral traps, additional income accelerates spending rather than savings. This is why high earners often feel perpetually behind, despite resources. The third hidden pattern, the mathematical architecture, reveals that without precise capital mapping and velocity control, increased inputs may amplify erosion rather than growth. It is counterintuitive, but universally observed. And here's the open loop for the next section. Even intelligence and awareness do not immunize you. Social pressures, lifestyle inflation, and decision fatigue collide with the architecture of compounding. This explains why highly educated, irrational individuals, even those who understand behavioral finance, still fail to accumulate meaningful wealth. The next section will explore why smart people fail anyway, exposing the structural social traps that operate invisibly, and showing how environment, programming, and subtle pressures dictate outcomes you cannot see until you map them. The mathematical truth is simple but brutal. Every unrecognized pattern, every behavioral slip, every structural leak interacts with compounding, thresholds, and velocity to create either exponential erosion or exponential growth. And the difference between the two is entirely under your control, once the patterns are exposed. If you think knowledge alone protects savings, think again. The fourth hidden layer reveals why even intelligent, disciplined, and financially literate individuals fail. This is the collision of social programming, lifestyle inflation, and decision fatigue. A pattern that is invisible until it overwhelms you. Understanding it is crucial because it explains why structural mastery and behavioral awareness without environmental control are not enough. Humans are social creatures. Every choice is influenced, subtly or overtly, by the expectations and behaviors of those around us. From family, friends, and colleagues to media and cultural norms, these forces create silent pressure on how we spend, invest, and perceive wealth. You might pride yourself on rational decisions, yet the social architecture nudges you toward conformity. You upgrade your car because peers upgraded theirs. You buy the latest gadget because influencers signal it is a necessity. You adjust your lifestyle not because it serves your goals, but because social validation has real, measurable impact on your psychological state. This is lifestyle inflation in action. The slow, nearly imperceptible expansion of expenses in response to perceived status cues. Decision fatigue compounds this trap. Every day presents dozens of micro-decisions with financial consequences. What to eat? What to buy? Which subscriptions to keep? The brain, wired for efficiency, defaults to familiar patterns and emotional shortcuts. Without systems in place, these defaults favor consumption. You may start the day with a plan to save, but by evening, cognitive depletion has eroded your discipline. Decision fatigue is invisible, yet it systematically undermines the very habits you believe define your control. Even intelligence cannot inoculate against this. Highly capable people often experience the sophisticated spender paradox. They earn more, understand more, and plan more. But their higher income fuels more complex lifestyle choices, higher expectations, and more sophisticated consumption traps. The more capable you are, the more nuanced the pressures become. Every increase in income is met with a proportional increase in subtle financial obligations, upgraded housing, more travel, social obligations, and status maintenance expenditures. Without active resistance, intelligence accelerates erosion rather than mitigating it. Here's another dimension: the environmental echo. Your surroundings, friends, neighborhoods, workplaces, media, reinforce spending norms. Humans measure adequacy contextually, not absolutely. You may feel wealthy relative to one group, but average relative to another. The constant, unseen comparison creates pressure that manifests as hidden, incremental spending. Your social environment is a silent tax, invisible yet unavoidable, unless deliberately redesigned. Most people accept this pressure unconsciously. Most people never question the rules of the game. That is why behavioral mastery alone is insufficient. The psychological overlay of guilt and reward is also powerful. When pressured by social expectation or lifestyle aspiration, you rationalize expenditure as justified, deserved, or necessary. You feel the emotional reward in the moment and push future consequences aside. This is why saving sabotage often feels like a reward, even when every rational calculation proves the opposite. And the compounding mathematics from the previous section amplifies the damage. Tiny emotional indulgences, repeated daily and reinforced socially, create systemic erosion that appears invisible until the consequences are unavoidable. Decision fatigue, lifestyle inflation, and social programming intersect with compounding to form a triple-layered trap. The invisible drain is relentless because it is not a single failure. It is continuous, systemic, and psychological. Awareness of one element without the others is insufficient. Most financial advice fails because it addresses behavior superficially while ignoring social and environmental pressures. Systems, not willpower, are required to counteract this. Here's the open loop for the next section. By now, you understand the architecture of erosion: structural leaks, behavioral sabotage, the mathematical compounding, and environmental pressure. But understanding erosion is not enough. You need a blueprint for accumulation, a system that not only stops losses, but converts potential into exponential growth. That is where the strategic wealth blueprint comes in. The next section will reveal step-by-step architecture for controlling capital, stacking assets, and building velocity that withstands invisible forces. Because here is the truth: intelligent people fail not because they are incapable, but because invisible forces exploit the very traits that make them successful. Recognizing the design is the first step toward building an unbreakable financial framework. And once you see the blueprint, erosion transforms into opportunity. Up to this point, you've seen the invisible forces eroding your savings: structural leaks, behavioral sabotage, compounding erosion, and environmental pressure. But knowledge alone doesn't create wealth. Awareness without action is merely anxiety with better data. The strategic wealth blueprint is your map out of the trap. A systemized architecture designed to not only stop erosion, but to convert latent potential into exponential growth. This is where the patterns reverse and invisible forces become allies. The first pillar is capital structuring. Every dollar must be assigned a role: accumulation, growth, protection, or optionality. Unallocated capital is passive risk. When income flows without structure, it defaults into behavioral traps. Assigning roles creates intentionality. For example, 50% may fund liquid savings for emergencies, 30% may flow into growth assets, 15% into skill or human capital development, and 5% reserved for calculated opportunities. The exact percentages can vary, but the principle is absolute. Unstructured money is invisible money, vulnerable to erosion. The second pillar is asset acquisition logic. Strategic wealth is not built by spending. It is built by identifying asymmetry between cost and potential. Real estate, index investing, business equity, and intellectual property are not merely assets. They are leverage machines. Each asset should be analyzed on 3 axes: risk exposure, cash flow potential, and growth asymmetry. The goal is not diversification for comfort. It is strategic exposure to asymmetrical opportunities where upside significantly exceeds downside. Ordinary savings accounts cannot compete here. They are neutral at best, destructive at worst when adjusted for inflation. Third is risk mitigation. Let many view risk as purely external: market volatility, economic cycles. But the hidden risk is internal: behavioral missteps, impulsive withdrawals, lifestyle inflation. The blueprint integrates risk buffers, automated allocations, staggered investments, and liquidity management. High-leverage strategies exist only where behavioral and structural protections are in place. Without them, upside potential becomes a liability, a trap masquerading as opportunity. Strategic mitigation converts risk into optionality. Skill stacking is the fourth pillar. Capital alone does not generate velocity. Knowledge and ability amplify outcomes. Every dollar invested in high-value skills compounds like money itself, unlocking higher income, better investment decisions, and unique leverage opportunities. This is not casual personal growth. It is tactical human capital architecture. Identify the skills that provide compounding returns across multiple vectors: negotiation, quantitative analysis, digital infrastructure, or market asymmetry exploitation. Stack them deliberately. Their effect is exponential, not linear. The fifth pillar is cash flow architecture. True wealth is not net worth on paper. It is resilient, controllable cash flow that can weather psychological and environmental pressure. Each income stream should be autonomous, insulated from behavioral leakage, and aligned with long-term compounding goals. Automate flows so that income bypasses temptation, directly serving growth and accumulation. When cash flow architecture is executed correctly, savings becomes frictionless. Behavioral and structural traps no longer intercept capital. They are bypassed entirely. Finally, long-term asymmetry thinking unites the blueprint. Most people think in months. The strategic wealth blueprint forces you to think in decades. It aligns structural, behavioral, and mathematical layers into a coherent system. Each small optimization, each automated allocation, each skill acquired, interacts with compounding to produce leverage invisible to outsiders but unmistakable in outcomes. The blueprint is not about shortcuts, it is about systemic advantage. This is where intelligence, discipline, and environment finally work for you, not against you. Here's the open loop for the next section. Once the blueprint is in place, the acceleration phase begins. This is where income and assets operate as a dual-engine system. Optionality expands, leverage is optimized, and timing windows create outsized advantage. Without acceleration, a blueprint stagnates, but with it, velocity becomes unstoppable. In the next section, you will see exactly how to ignite growth with precision, turning a well-structured system into an engine of wealth that moves faster than behavior or environment can erode. The strategic wealth blueprint transforms invisible erosion into visible leverage. It converts passive risk into active opportunity. And once mastered, it provides the framework not just to survive, but to thrive. The blueprint is in place, your system structured, your assets and skills stacked. But structure alone does not create speed. This is where the acceleration phase begins, the stage where your financial ecosystem moves from steady accumulation to exponential momentum. It is the phase that separates the disciplined from the truly strategic, where every hidden pattern you have identified transforms from obstacle into leverage. The first principle of acceleration is the dual-engine system, income and assets operating in tandem. Income is energy, the fuel of your system. Assets are the machinery that multiply that fuel. Without coordinated engines, your system stalls. Many savers optimize one at the expense of the other. High earners neglect asset growth, while asset holders ignore income maximization. In acceleration, these engines are synchronized. Your active income feeds growth assets. Your assets generate passive cash flow that supports optionality. Each engine amplifies the other, creating compounding not just in dollars, but in momentum. Optionality is the second principle. True acceleration does not rely on linear progress. It relies on choices with asymmetric upside. Each asset, skill, or connection is evaluated not only for current utility, but for potential future leverage. The ability to act decisively when rare opportunities arise is what creates outsized gains. Optionality is invisible to those trapped in routine. It is the hidden weapon of accelerated wealth. Missed windows are permanent opportunity cost. Captured windows compound. The system rewards patience until it is time to strike. Leverage is the third principle. But here is the critical distinction. Acceleration requires control, not blind exposure. Financial leverage can amplify growth, but it also amplifies erosion if misapplied. The invisible forces you have mapped, behavioral, structural, and environmental, become magnified under leverage. Controlled leverage means applying it only where risk mitigation, capital buffers, and system protections are in place. Misused leverage destroys momentum faster than any behavioral trap. Mastery is not about taking the biggest bet. It is about scaling intelligently within the system. Timing windows are the fourth principle. Acceleration is not constant. It is episodic. Markets, opportunities, and personal capacity all fluctuate. The strategic wealth blueprint positions you to exploit timing asymmetries, periods of low friction, market inefficiencies, or skill-based advantage. Most people fail because they try to accelerate without synchronization. They apply effort blindly, outside optimal windows, and the system punishes them. Understanding and respecting timing transforms small advantage into irreversible momentum. The fifth element is iterative feedback. Acceleration is dynamic. Every action produces measurable consequence. Assets that underperform, streams that stagnate, behavioral leaks that emerge. These are data points. A high-velocity system constantly adapts, reallocates, and optimizes. Static plans do not accelerate. Adaptive systems do. By measuring outcomes, you convert hidden erosion into actionable intelligence, continuously improving the engine's efficiency. Consider the psychological overlay. During acceleration, temptation is amplified. As income grows and assets generate returns, behavioral traps appear disguised as opportunity. Social pressure intensifies. The lifestyle inflation becomes more seductive. Without prior mastery of structural and behavioral patterns, acceleration can backfire. The same forces that previously eroded savings now threaten to dismantle growth at higher velocity. The system rewards those who act with discipline, who automate protective structures, and who maintain optionality. Here's the micro cliffhanger for the next section. Acceleration alone is not sufficient. Even the most powerful dual-engine system cannot sustain velocity without internal alignment. Without psychological rewiring, delayed gratification, and identity evolution, momentum is temporary. The next phase, identity evolution, will show how to rewire your mind, extend your planning horizon, and detach emotionally from ephemeral pressures, making acceleration permanent and compounding unstoppable. The acceleration phase turns knowledge into force. It turns structure into movement, and it turns disciplined systems into an engine capable of outpacing both environment and unconscious behavioral sabotage. But without the internal transformation of identity, even the fastest system will eventually stall. Acceleration alone is not mastery. Speed without internal alignment is unstable. It burns out, stalls, or collapses under the weight of unrecognized pressures. Identity evolution is the hidden engine that sustains compounding momentum. It is the stage where your psychology, your perception of self, and your internal framework are redesigned to operate at a higher financial frequency. Without it, the systems you've built remain fragile, vulnerable to subtle sabotage by old patterns. The first shift is temporal recalibration. Most people operate in months, weeks, even days. Your mind is wired for immediate reward, making long-term planning feel abstract, distant, or even irrelevant. Identity evolution rewires this perception. You begin to think in decades, not months, generations, not years. Every dollar is evaluated not only for immediate utility, but for its long-term compounding effect. Decisions that once felt inconsequential are now strategic levers, invisible in their immediate impact, but enormous across time. This is delayed gratification, not as a principle, but as an identity. You become the person who prioritizes future power over instant satisfaction. The second shift is strategic detachment. Emotional impulses, social pressures, and status cues no longer dictate behavior. Where before your identity was reactionary, defined by comparison, approval, and fear, it now becomes deliberate. You separate self-worth from consumption, from social perception, and from immediate reward. By detaching psychologically, you remove the invisible leakage caused by behavioral sabotage. The mind becomes an instrument of strategy, not a victim of circumstance. Emotional neutrality is not coldness, it is freedom. It allows you to act in alignment with long-term compounding forces rather than transient pressures. Third is the internalization of systemic thinking. Previously, you understood the external system, structure, compounding, and environmental pressures. Now you internalize it. Your identity is calibrated to recognize patterns before they occur, anticipate friction, and respond proactively. Financial decisions become pre-programmed extensions of self, is instinctively aligned with the strategic wealth blueprint. Where once behavior was chaotic and reactive, it becomes precise, predictable, and scalable. This is identity as architecture. Your psyche becomes part of the system itself. Fourth is resilience under friction. As acceleration amplifies outcomes, social pressure, lifestyle temptation, and decision fatigue intensify. Identity evolution embeds psychological armor. You no longer experience erosion as a moral failing. It is recognized as a design problem. You're capable of recovering swiftly because your self-perception has shifted. Wealth is not about momentary victory, but about consistent alignment with system rules. Setbacks are data, not judgment. Losses are temporary. Compounding advantage is permanent. This mindset converts volatility into opportunity, fear into clarity, ease and friction into leverage. The fifth element is recursive identity reinforcement. Every successful execution, every protected flow, every delayed reward strengthens the identity. Over time, these patterns compound just like capital. Habits, when aligned with identity, become automatic. Behavioral traps are bypassed before they manifest. You no longer rely on willpower. Willpower is finite. Instead, your system operates naturally through the architecture of identity. You become a person whose behavior inherently supports accumulation, velocity, and optionality. Here's the micro cliffhanger leading into the next section. Identity evolution prepares the mind to redefine wealth itself. Once the internal system is rewired, external markers, income, status, and assets are no longer the measure of freedom, power, or success. The next phase, a wealth redefinition, will expand your perception, showing that true wealth transcends money and that liberation comes from alignment with invisible structures, not external validation. Identity evolution is the bridge between tactical execution and strategic transcendence. Without it, acceleration fades. With it, the system becomes self-sustaining, compounding not only capital, but the person directing it. Up to now, you have seen how structural leaks, behavioral sabotage, compounding mathematics, environmental pressure, strategic blueprinting, acceleration, and identity evolution all converge to shape financial outcomes. But even mastery of these systems is incomplete if your perception of wealth remains tethered to conventional metrics, income, possessions, status, or applause. Wealth redefinition is the final paradigm shift, the stage where money ceases to be an endpoint and becomes a tool, a vector for freedom, influence, and long-term leverage. The first shift is redefining wealth beyond income. Most people equate earning more with being wealthier, but income is merely energy. It is not the asset. It is the fuel powering growth. True wealth is capital velocity, the ability to convert resources into opportunity, leverage, and optionality without being enslaved by the process. A $50,000 salary with structured capital and disciplined asset stacking can create more long-term power than a $200,000 salary dissipated through behavioral and social leakage. Income alone is illusionary. Wealth is the capacity to act independently, sustainably, and asymmetrically. Second is redefining freedom beyond consumption. If freedom is rarely granted by accumulating luxuries, it is claimed by systems, choices, and insulation from external pressures. Wealth that is tied to visible consumption is fragile. It is hostage to social validation and lifestyle inflation. True freedom is the ability to direct time, attention, and capital toward value creation, strategic relationships, and personal objectives without interference. Assets, cash flow, and skill stacking are not simply for accumulation. They are instruments that protect freedom from the erosive forces previously described. The wealthy are not those who spend more. They are those who control more. Third is redefining power beyond status. Power is often misunderstood as influence, recognition, or external authority. In reality, It is optionality manifested in decisions. You gain power not by convincing others, but by possessing internal alignment, invisible leverage, and structural advantage. Each financial and psychological layer you have developed, blueprint, acceleration, identity evolution, translates into a capacity to act decisively under conditions most cannot navigate. Status can be copied or faked. Power derived from systemic mastery cannot. It compounds, scales, and endures. Wealth redefinition also reshapes risk perception. Previously, threats were external or reactive: market swings, peer pressure, lifestyle inflation. Now, risk is internal and strategic. You measure it against asymmetrical opportunity, compounding potential, and alignment with long-term objectives. Losses are reframed. Minor erosion in the short term becomes acceptable when viewed as part of an adaptive, scalable system. Your perception of scarcity dissolves. Abundance is recognized not as luck or circumstance, but as the natural outcome of a calibrated system operating under the laws of hidden patterns, velocity, and identity alignment. Finally, this phase embeds permanence. Without redefining wealth, even mastery of systems is transient. Behavioral or social forces can erode gains. With redefinition, wealth becomes self-reinforcing. Capital, identity, and optionality are integrated. The system no longer requires constant intervention to function. Each element, assets, skill, cash flow, identity, interlocks, creating a resilient architecture where compounding, velocity, and freedom are no longer theoretical. They are lived reality. Here's the open loop leading into the final section. With wealth redefined, the path is clear, but clarity alone is insufficient. A real transformation requires action, a challenge to apply the systems, mindset, and redefined framework. The final section will crystallize all patterns, provoke strategic action, and issue a direct call to ascend into sustainable mastery. It is here that knowledge, identity, and structure converge into decisive, irreversible momentum. Wealth redefinition is not about more money. It is about autonomy, influence, and resilience. It is the lens through which all prior patterns, leaks, sabotage, compounding, environment, blueprint, acceleration, and identity interact seamlessly. Once reframed, every decision, every flow, and every strategic move becomes aligned with long-term, asymmetrical advantage. This is the summit of invisible mastery. You now see the full system: the hidden structural leaks, the behavioral traps, the compounding mathematics, the social pressures, the strategic blueprint, the acceleration phase, the evolution of identity, and the redefinition of wealth. Each layer interacts, creating forces that either erode or amplify your financial potential. You understand that nothing external, no paycheck, no advice, no fleeting motivation, controls your outcome. The control lies within the architecture you build and the identity you inhabit. This is your challenge: to apply what you now know, to stop leaving capital in invisible drains, to redesign your flows, your choices, and your environment, to synchronize income and assets, to leverage optionality, and to harness acceleration without surrendering to behavioral sabotage, to commit not to temporary gains, but to sustainable, compounding, one asymmetrical growth that aligns with who you are becoming. Visualize your future self, 10 years, 20 years from now. See a system operating effortlessly, where wealth is not a source of anxiety, but a tool for freedom, influence, and resilience. Feel the velocity of capital moving unimpeded, the confidence of identity aligned with structure, the clarity of decisions no longer hijacked by fleeting impulses. That future is not a dream. It is the logical outcome of consistent application of the patterns you now know. This is a call to action, not to motivation, but to mastery. Do not wait for circumstances to improve. Do not rely on external validation or luck. Reclaim your system. Align it with your identity. Protect your flow. Activate acceleration. Redefine wealth on your terms. The invisible forces that once drained you are now visible, and they can be reversed. Your decision is the first compounding action. The next step you take today multiplies exponentially in the decades ahead. Ignore it, and the patterns will reclaim momentum. Act, and you will ascend beyond what most even imagine as possible. Here is the line to anchor everything you've learned. Master the invisible system, and the world of money becomes your instrument, not your master.